Welcome everyone. Thank you for joining our webinar. My name is Tanya Lopez and I am the Marketing Senior Executive here at HLB Manjud and your moderator this morning. Today we are presenting Unpacking the Federal Budget, Positive Cashback Impact for Business, presented by our panel of experts, HLB Manjud Tax Consulting Director Alex King and Tax Consulting Partner Mariana von-Luken. Our agenda today will consist of Alex King covering instant asset write-off, loss carryback rules, corporate tax rate, expanded access to small business concessions, and corporate tax residency, followed by Mariana von-Luken, who will discuss the R&D tax incentive, JobKeeper 2.1, and JobMaker. Now, without further ado, I will hand it over to Alex King.
Thanks, Tanya, for the introduction. Hello, everyone. So as Tanya said in the agenda, we'll be looking at some of the measures introduced in the most recent federal budget. So the focus of the federal government's budget was to introduce measures that would assist struggling businesses to return to a more normal operating capacity and also get workers back to work in a post-COVID recovery. Understandably, given the current circumstances, the government didn't deliver any significant changes or holistic tax reform. There were about 18 tax-related measures announced in the budget, mainly benefiting small to medium enterprises and individuals. In today's presentation, we'll be focusing on those measures that target businesses and their employees. A common theme in the measures announced in the budget is the cash flow benefits that they'll provide businesses and employees. So that's what we'll discuss today. So the first measure we're looking at is an extension to the existing instant asset write-off rules. The new rule provides a very generous immediate deduction for the purchase of eligible depreciable assets for businesses with aggregated annual turnover of less than $5 billion. The measure is intended to improve cash flow for qualifying businesses and to encourage businesses to buy equipment and invest in growing their business. Unlike the existing instant asset write-off rules, there is no cost limit for eligible assets acquired. Basically, to be eligible for the immediate deduction, the asset just has to be first held by a taxpayer from the night of the budget, which was 6th of October, and have it installed ready for use by 30 June 2022. All types of entities are eligible to claim the deduction, so it doesn't matter if you have your business in a company or a trust or partnership structure. One of the main requirements is that the eligible asset just needs to be located and used in a business in Australia. The government claims this measure will apply to 99% of businesses given the very high turnover threshold. However, taxpayers should be aware that when applying the aggregated turnover rules, they do need to include the turnover of foreign businesses as well, potentially if they're part of a larger foreign group or have foreign affiliates. So looking at what assets are eligible and what assets are excluded from these rules, broadly speaking, only new assets that are depreciable under Division 40, subject to some exclusions, are eligible to be fully written off when they're acquired or installed. In addition to actual purchasing new assets, taxpayers can also claim the cost of improving existing assets. As I mentioned before, there is no limit on the cost of the asset, unlike the existing instant asset write-off rules. In general, there's a rule around eligible assets that it's that you must hold the asset in order to get the deduction. In general, that refers to the owner of the asset. However, there are some circumstances where a taxpayer, for tax purposes, will hold the asset where it's under certain lease agreements, just depending on the term of the lease. There are additional assets that may qualify for the immediate deduction for small to medium enterprises with turnover of less than $50 million. In addition to new assets, they'll also be able to deduct the cost of second-hand assets, as well as deduct the cost of assets where they had a pre-existing commitment to buy that asset before 6 October. So some of the excluded assets from these rules, so buildings or capital works, although technically you can claim tax depreciation on those, they're not depreciating assets under Division 40, so therefore not eligible for the immediate deductions. Similarly, assets not used or located in Australia are not eligible. Assets in low value pools and software development pools also don't qualify for the instant asset write-off. And some certain primary production assets, such as like water facilities, fodder storage assets and fencing, although note that these are usually deductible immediately under separate provisions. Thank you. So taxpayers should look at the new instant asset write-off rules in the context of the existing pre-budget investment incentives. So prior to the budget, the government had introduced the enhanced instant asset write-off. Now this provided an immediate deduction for the cost of assets up to $150,000 and applied to businesses with aggregated turnover of up to $500 million. And it applied to new and second-hand assets acquired between 12th of March 2020 to, I think that should actually be 31st of December 2020. The budget announcement actually extended the period that taxpayers had to install these assets to 30 June 2021. There was also the backing business investment incentive as well, which provided taxpayers with an immediate 50% deduction for the cost of eligible assets at the time of installation. So it was accelerated depreciation. And again, that applied to businesses with aggregated turnover of up to $500 million. So that basically covered accelerated depreciation if you had assets that cost over $150,000. And again, that applied to assets acquired between 12th of March 2020 and that were first used or installed ready for use by 30 June 2021. Just in that threshold of $150,000, that is a per asset threshold. So you could have several different assets, each of which in total could be over 150,000, but if each one is less than that amount, then they'll qualify for that immediate deduction. So this table just summarizes the new full expensing of depreciating assets, which is the new rule that was announced in the budget, as well as the pre-budget incentives, the enhanced instant asset write-off. I won't go through this table in detail, but it just shows you there is quite a bit of complexity depending on when you acquired an asset and how much the asset cost, and as well what the aggregated turnover of your business is as to which rules will apply to you. In respect to the cost threshold, I think it's also just important to note that the car limit still applies. So the car limit for the 2021 financial year is $59,136. So some planning considerations in relation to this new instant asset write-off rule. So the first point there is looking at, as I mentioned before, do you actually hold the asset for tax purposes? Particularly, this could be a little bit confusing if you're looking at your financials, particularly with change in the leasing standard for accounting purposes. So you could have a right of use asset that is disclosed on your balance sheet as an asset, but is actually an operating lease. In that case, even though on the balance sheet you'll have that asset, it won't qualify for the immediate deduction. So the instant asset write-off rules could result in some significant differences between accounting and tax. aggregated turnover. So as I mentioned before as well, just need to be careful when applying the aggregated turnover test for the purpose of the new asset write-off rule that allows you to fully expense pretty much all assets. $5 billion is extremely high turnover threshold. And so only those entities that are part of quite large foreign groups potentially that it might be an issue, that they might not qualify. It's also important to distinguish between depreciable assets versus structural improvements. So again, as I mentioned before, buildings and improvements to buildings, expenditure for those types of depreciating assets don't qualify for the immediate asset write-off. It's only depreciable assets under Division 40 of the Tax Act that are eligible. So that's typically, your plant and equipment, basically your assets that you can sort of pick up and move around. Then the fourth point there I have is review your fixed asset register and systems. So, in order, that table a couple of slides earlier showed that there is quite a complex bunch of rules around assets and depreciation and instant asset write-off. So, taxpayers should look at their fixed asset register systems to see if it can accommodate the new rules. Taxpayers also need to be looking at the date that they acquired assets, what the cost was when they're inputting them into the system, to make sure that they claim correctly. In regards to the instant asset write-off rule that was announced in the budget, taxpayers do not actually have a choice to apply that if the asset is eligible and the taxpayer is eligible, then the deduction is going to apply. So there's no choice to apply that. So it's important that taxpayers look at their systems to make sure that they can accommodate these changes. I have one client, for example, that these rules is a very important consideration, particularly when you're considering, is the asset depreciable asset or building, and what date the asset was acquired or held. So this particular client is a hotel, and obviously with the start of the pandemic, they had to close most of their rooms. So they had plans to refurbish the hotel, which they actually brought forward because the hotel was largely closed. So they brought forward that refurbishment to April this year. So in looking at all the assets that they're paying for as part of that refurbishment, it's important that they distinguish between what is a depreciable asset and what is a structural improvement. Unfortunately for them, because they committed to the refurb before the budget announcement on the 6th of October, they're not going to be eligible for the immediate write-off for all the assets where it costs over $150,000. They're only going to be able to deduct those assets because they were committed to it before the budget announcement. They'll only be able to deduct assets up to $150,000 and then also claim the 50% immediate depreciation deduction. So if they were to start a new project from now up to 30 June 2022, they would be able to get the full write-off for the full amount of any assets purchased, regardless of their cost. So the fifth point there, the decision to purchase assets should be commercially driven. So, just because there's a tax incentive, if it's not a commercially sound decision to buy an asset, then taxpayers should be buying assets just to get the immediate write-off. And so it's possible that with these very generous write-off rules, that a taxpayer could make some significant investment in new assets and put the company into a tax loss position. Now, that is useful to note when we talk about the next measure introduced by the budget, which is the tax loss carryback. So the second measure we're going to discuss is the temporary loss carryback rules. So these rules are designed to provide a temporary cash flow support to companies that were previously in a tax-paying position, but now find themselves in a tax loss position, either due to the pandemic or as a result of the being able to obtain additional deductions for depreciating assets under the instant asset write-off rules. So in essence, taxpayers can get a refundable tax offset where they have a tax loss either in the 2020, 21 or 22 financial years, and they paid income tax in an earlier year, starting from 2019 financial year. It's not the first time the government has had a loss carryback rule. In the Gillard government back in 2013, they introduced a very short-lived loss carryback rule. Unlike the rule back then, which was capped, the tax offset was capped at $300,000 per annum. With this temporary loss carryback rule, there is no cap on the tax offset that can be claimed. While this measure is going to provide cash flow support for some companies, unfortunately, that cash flow support is not immediately available because the tax offset can only be claimed in the 2021 and 2022 tax returns. So there is potentially some time businesses will have to wait before they can get the cash flow benefit of this particular measure. One other limitation, I suppose, of this or issue with this measure is that it only applies to businesses operated through companies that had losses in prior years. Businesses not structured as companies will not benefit from these loss carryback rules. So this just summarizes the core rules in relation to the loss carryback. So eligible losses are those incurred in the 2020, 21 or 22 years. The eligible tax profit income years, so you can only get a refund of tax paid in the 2019, 2020 or 2021 years. So if you paid tax for 2018 or earlier years, you're not going to be able to get that back under these loss carryback rules. As I mentioned, the offset can only be claimed in the 2021 and 2022 tax returns. Eligible entities able to make the claim for the loss carryback, corporate tax entities, they must be carrying on a business. So if you have a investment company, potentially that wouldn't apply. And the entity must have aggregated turnover of less than $5 billion, which is the same test as the previous measure on the new instant asset write-off rule. Taxpayers must make a choice to carry back the loss, and they can actually make a choice as to how much of the loss to carry back, subject to certain limitations. And one of the integrity measures is that an entity must have lodged tax returns for the previous 5 years. So it has to be up to date with all its tax returns before it can claim the tax offset for the loss carryback. So some of the limitations on the loss carryback. So the amount of the refund you get is limited in 2 ways. So first of all, the loss carried back cannot exceed the balance of earlier taxed profits, and the amount refunded also cannot be more than the balance of the franking account in the year that it's claimed. Not all losses as well can be carried back. So capital losses can't be carried back. It's only tax losses, revenue losses. Similarly, losses transferred to a tax consolidated group by a joining entity are not eligible to be claimed as a loss carryback. So you can't buy or have a loss-making subsidiary and then form a tax consolidated group or acquire that entity and then use those losses to offset against previous income paid, tax paid. Also, you can't use losses generated as a result of excess franking offsets. You can't claim those as a loss carryback. Other considerations are that the amount of the refundable offset is going to be based on the corporate tax rate in the loss year, not the profit year. So that's relevant, particularly if you're a base rate entity and your tax rate is changing in these years. It's also important to note that although this is a refundable tax offset, the ATO could offset the refund against other amounts owing at the time to the ATO. So, if you have other amounts owing like pay-as-you-go withholding, GST, FBT, etc., to the ATO, then you lodge your tax return and claim this tax offset to get a refund. You might, if you have these other debts outstanding, the ATO might automatically offset the loss carryback refund amount. So there are also some other integrity measures. So in addition to the general anti-avoidance rules, there's also specific anti-avoidance rules targeted at taxpayers using this loss carryback measure. So in respect to the specific integrity rule, it's basically targeting schemes where there's a disposal of membership interests in a company that result in a change of control of the company. And having regard to all the circumstances, it's clear that change in ownership was done predominantly for the purpose of enabling the corporate tax entity to get a loss carryback tax offset. So there's a few ATO red flags there. So it could be, the disposal of the company with a tax-paying history. It could be selling a company, stripping the assets of the company, then selling it. The company has a bunch of franking credits in its franking account. Other considerations are if you're buying a business, are you continuing with the same assets in that business? Is the nature of the business the same or is it different? So they're relevant considerations. And if the specific anti-avoidance rules don't apply, then there is also the general anti-avoidance rule that needs to be considered. I probably would note that there is no issue with making a decision to purchase or invest in new assets to get the instant asset write-off, get the additional deductions. In the explanatory memorandum to this rule, the government specifically mentioned that was a feature of the loss carryback rule to allow taxpayers that do get additional deductions because of those instant asset write-off rules to generate losses. That's not an issue. If a taxpayer makes that decision, and then they can benefit from the tax carryback offset. Some planning considerations in respect to the loss carryback. So first, taxpayers should compare and model out the cash flow, franking, and other consequences of claiming the loss carryback offset. They also need to compare the difference between carrying back the loss and claiming the offset versus carrying forward the losses as usual and offsetting against future profits. In most cases, it's probably beneficial to get the cash flow benefit by carrying back the loss. Also, carried forward losses are going to be subject to the continuity of ownership test and the same business test. So they could still be at risk of being lost in the future if you don't use them now. So in that case, sometimes it might be better to use them and carry them back. In considering the application of these rules, taxpayers should also first, make sure the aggregated turnover of the group is less than the $5 billion threshold. They should look at their entity and see, have they paid tax in 2019? Do they expect to pay tax in 2020 and 2021? And have they incurred tax losses either in 2020 or do they forecast any tax losses for FY21 or 22? And they should also estimate the franking account balances at the end of these years. How much tax do they expect to pay? How much tax have they paid? As well as franking credits they might receive through dividends from other companies. It's also important to consider the dividend payment plan and the potential impact this could have on the franking account balance. Or could claiming the tax offset for the loss carryback impact their franking account and limit how much they can frank dividends in the future as well. And finally, should also consider the timing of deductions. So with the accelerated depreciation and immediate deductions for asset purchases available, look at when they should make those investment decisions. And then, are there any other deductions that could be brought forward that would generate a tax loss? So for example, salaries or directors' fees, could they be claimed in perhaps a year earlier and then generate a loss which then can be carried back and generate a bit of a cash boost? Thank you. So just a bit of an example here on the application of the loss carryback rules and actually how this interacts with the instant asset write-off. So this is just a simple example adapted from the budget fact sheet. So Bogong Builders Pty Limited in the 2021 financial year had aggregated turnover of 60 mil, so under the $5 billion threshold, but they're not a base rate entity because they're above the $50 million threshold, so they pay tax at 30%. So on the last day of the financial year, 30 June 2021, they purchased a concrete pump for $1 million exclusive of GST. So the taxable income before taking into consideration that purchase was $600,000. So they'll have tax payable of $180,000 for the year. However, because of the instant asset write-off rules, they'll be able to deduct the cost of that $1 million asset in the year they acquired it. So instead of having a taxable income of $600,000, they actually have a tax loss for the year of $400,000. So when completing their 2021 tax return, the company notes that it has a franking account balance of $120,000, and they actually paid tax back in the 2019 financial year of $120,000. So they choose to calculate a loss carryback tax offset. So in this case, that's equal to the $400,000 loss times the tax rate of 30%. So that's $120,000, and they carry that back to the 2019 year, and they can claim a loss carryback tax offset in their 2021 tax return that results in a 120K refund. So in this case, they get a 120K cash refund, which obviously can help fund the purchase of that new asset. And actually, if you look at it holistically, they actually had a $300,000 cash flow benefit due to the operation of both these rules. If it wasn't for the instant asset write-off rule, they would have had to have paid tax of approximately 180K for that year. So not having to pay the 180K tax plus the 120K refund, that's a cash benefit of 300,000. So these new rules, that just shows these new rules can deliver some significant cash flow benefits for taxpayers. Thank you. So just a point on the corporate tax rate now. So this was actually something that there was no change announced in the budget to the previously legislated changes to the corporate tax rate. So for non-base rate entities, the tax rate remains at 30%, and the aggregated turnover threshold remains at $50 million. So those that are base rate entities, the previously announced progressive reduction of the tax rate, there's been no change. So the 19-20 years, it's 27.5%, 2021 reduces to 26%, and the 2022 year reduces to 25%. So taxpayers that are base rate entities just need to be aware of that because it is relevant for when they're working out the franking rate of dividends, and also for calculating the amount of the loss carryback tax offset that they might be entitled to. So just an additional variable that if you're a base rate entity that you need to consider when applying some of those rules. So this was just the third measure that we were going to address that was announced in the budget. So it's expanded access to small business concessions. So prior to the budget, an entity that was considered a small business entity was one where had aggregated turnover of less than $10 million. And the small business entities, of course, are afforded a number of tax concessions. So as announced in the budget, from 1 July 2020, the government increase the aggregated turnover from 10 million up to $50 million to be able to access the concessions listed in the table on this slide. For the other small business entity concessions, the usual $10 million threshold remains. So you can see here there's just a bunch of tax concessions. I think ones that for businesses that are particularly relevant is with the FBT exemption for car parking benefits, which will apply from 1 April 2021. That's probably important, particularly if the government was going to expand the definition of car parking benefits, which they're intending to do. Also, the FBT exemption for multiple work-related devices. So previously that applied to only small business entities less than 10 mil. So up to 50 mil, you can buy more than one electronic device for employees, and it won't be subject to FBT. They're probably two of the main benefits there. So this is the last measure that I'll be addressing this morning, and that's just a change to the corporate tax residency rules. So the application of the corporate residency test on foreign incorporated companies became really uncertain after the High Court's decision in 2016 in the Bywater case, and the corporate residency test has sort of been in a state of flux ever since. So the current interpretation of the residency test treats a foreign incorporated company as a resident if its central management and control is in Australia. So the current interpretation basically ignores the location of actual operations of the company and the day-to-day management of the company. So for example, you may have a company, a subsidiary that's incorporated in New Zealand, and it also operates a business in New Zealand. However, under the current interpretation of the rules, if you have a single person potentially undertaking board level management activities in Australia, regardless of the location of the physical business carried out by the company could be an Australian resident for tax purposes. So the proposed change will amend the law so that a foreign incorporated company will only be an Australian resident company if it has significant economic connection to Australia. So that basically means that a foreign incorporated company will only be an Australian resident if it's got its core commercial activities in Australia and its central management and control in Australia. So really this new test is basically codifying into the tax law what the old test was prior to the Bywater case, and hopefully should provide a bit more certainty. It's probably particularly welcome now during the pandemic, as directors of foreign companies may have been stranded in Australia as a result of travel restrictions, and having to make decisions in Australia under the old rules could have potentially affected corporate residency. And the new rule can apply retrospectively back to March 2017. So hopefully there's a bit more clarity on the application of the corporate tax residency. So I think that was the last slide I had, and now I will hand over to Mariana.
Thank you. With the budget announcement, the R&D tax incentives, what the changes were, I did a presentation previously a couple of weeks ago. If you attended that, I apologise. I will go through it fairly quickly. The other one I was going to talk about was the JobKeeper 2.1. That wasn't in the budget, you're right, but it was before the budget. I just want to refresh and just make sure everybody's where are we at with that and what we can still claim. And then something that was announced in the budget, the JobMaker, which I think is quite an interesting concession, which probably businesses aren't quite aware yet that it's out there. So I'll go through that in a bit of detail. So just for the R&D tax incentive, just a little fact here that it was interesting to see that in 2015-16, you had 17.3 billion in spend. So that's expenditure. And SME registrations, 11,062. So that's just SMEs. So they're under 20 million turnover. And that's with Oz Industry. And then if you look at it, compare it to 2019, and all this is reported The ISA reports all this every year and what expenditure, how many registrations and so on, available information. And in 2019 was interesting. The spend was less, 11.92 billion, and the SME registration went down as well. Now, I think that'll all change after the budget that was announced. And I think that the slowdown, if you like, was because of the uncertainty in the rules. As you know, there's been some reviews. As you can see, there was kind of like, it's a story that started back in probably 2016. There was review of the R&D tax incentive. They said, you know, we should make all these changes. Obviously, like usual, nothing happens. And then the budget back in 2018, the government said, okay, let's do something. They brought out some changes. Nobody liked them. They were just restrictive. They would be reducing the rate. They wouldn't be very incentivized for the large entities. So then it got kicked out. Then they reintroduced it, pretty much the same, got kicked out again. And as you would have it, luck would have it, luck or COVID. Because of COVID, they've made the budget for R&D more open, accessible, because they want the economy to thrive, and R&D will assist that. So there'll be some changes from 1 July 2021. So, you know, currently, if I look at it, businesses that have turnover under 20 million, and just remember, it is aggregated turnover. So if you have foreign owned, you have to, and you're 100% or controlled by a foreign entity, you have to take in their turnover to work that out. But in most cases, your SMEs will be under the 20 million mark. So 30th June 2020, there's an opportunity to claim right now. It's going to be 43.5. Now it's 43.5. It's not connected, the incentive is not connected to the tax rate. So you can see there that I've just separated just to sort of see what the tax rate would be in 2020, which is 27.5 for most businesses, base rate entities, active businesses. And then the benefit is 16%. But as you can see, as the tax rate goes down, so in 2021, the tax rate is going down to 26, yet our rate, our R&D rate refund is 43.5. So it's not connected to the tax rate. And then the net benefit is 17.5. And that was the concern of the government. Well, our tax rates are going down, yet the benefit is staying high. So let's connect the net benefit, make it fixed, and as the tax rate moves, there's no problem. But I don't see many businesses, I don't think there'd be any businesses, I'm happy to have a discussion with anyone about turnover of under 20 million with a 30% rate. I wouldn't say that because you'd have to be a passive business. If you're passive, you're probably not doing R&D. For the larger businesses, so turnover over 20 million or aggregated turnover over 20 million, you're looking at that rate of 38.5. So what does that really mean? If the tax rate at 30th of June 2020 is 27.5, now remember that's going to go down, your rate is 13.5. Now, as the rate goes down, it's getting better. It's quite good because now previously businesses would have not have received as much incentive. So just to remember, it's got to be carried out in a company, a bit like the carryback losses, to be, you know, to even look at R&D. You have to own the IP. If you're foreign owned, your parent could potentially own it. You have to bear the financial risks. Your spend has to be over 20. It can be under 20 if you use one of those service providers. You have to have core or supporting activity. The main thing is to have core activity, and documentation is key. Have documentation. I don't want to go through the whole rigmarole of what is R&D. I just really want to go through what the changes are. So core activity, if you just recall, we have to be carrying out experiments. This is not your everyday sort of business stuff, all right? You're carrying out, you want to seek some new knowledge. You might have a new knowledge in creating a new product, an improvement, a process, a device, a service, something new. Then you've got to carry out some experiments. That the experiments you have to carry on based on the principles of some sort of science, computer science, etc. A principle of you know, hypothesis, experimentation, observation, like an experiment effectively, and you come to a conclusion. Now, it doesn't have to be successful for you to get R&D, but you certainly have to be able to document it. So what happens on 1 July 2021? So we've established that at 30th of June 2020, which R&D claims are going through right now, and 30th of June 2021, no change. As it is for small and large, no change. That's fantastic. So what did the budget say? How are we expanding it? So from 1 July 2021, they're saying with any businesses under 20 million turnover, the rate is going to stay at 43.5. So what they've changed is they're saying that the incentive, the net amount, so the 18.5 will follow the corporate tax rate. So for refundable entities, the corporate tax rate in that year, so that'll be 30th of June 2022, the corporate rate will be 25%. So 25% plus 18.5 gives you 43. So from that year onwards, it's going to stay the same, but if the tax rate moves down again, it'll still stay at 18.5, but your tax rate might be 20. Now, as far as I know, the tax rate isn't going to move any further down, but you never know. There is no cap. There was a proposal to cap the refund to 2 million or 4 million, but that's gone out the door. So we're not capping it. So there's no problem there. This one's an interesting one. So this is the non-deductible amount. So this is where you've got turnover of more than 20 million. So this is for the larger entities. So what it's doing, it's doing an R&D intensity rate. Why is it doing that? It's really trying to get R&D growth. So those entities that are predominantly doing more R&D will get a better rate. So if 2% of your expenditure, so 2%, say that's worked out by your R&D spend over your total expenditure is less than 2% or less, then what you're going to get is 8.5% plus your corporate rate, whatever it is. So it could be 30%, it could be 25, depending on what year, it could be 26, whatever the corporate rate is. But from 1 July 2021, it'll be the corporate rate plus 8.5. And I've got another slide just to show you how that would work. Maybe not yet. That's pretty new. And then intensity rate. So if your R&D spend is over 2%, then you can see your rate is 16.5 plus your corporate rate. So you're gonna get that as a rebate. So that's just going to go in there as you're already going to get your corporate tax rate as a carry forward loss plus an extra 16.5. So just a bit of an example here. We're looking at the 30th of June 2022 year. Just remember that. You've got an R&D spend of 160 million. I don't have any clients like that, sorry. But that's an R&D intensity of 15%, so well over 2%. But I just like that number. And the normal spend, just normal spend is $1 billion. Yeah, it's lovely, isn't it? So your turnover is definitely greater than 50 million. So you're at the 30% rate. So you've got to keep all these things in mind when you're looking at the R&D. Now for tier one, what you're doing is you're apportioning it. So it's a bit like your progressive rate of tax. So the first 2% gets 8.5% plus your corporate rate. And you take a portion of your spend, and that's 20 million. So the offset amount is 7.7 million. And then you look at what's greater than 2%. Well, that gets 16.5. So it's progressive. Now, what the change has been and what has made this a little simpler is that they've only made it 2 tiers. In the first proposal, it had 4 tiers. So imagine how hard that would have been to calculate. When they reintroduced the legislation, it had 3 tiers, so 3 intensity rates. Again, it's harder to calculate. So it's a bit like calculating your progressive rate of tax. The first lot only gets this much, the second lot only this much. Really complicated. So it's a lot simpler with 2. And it actually works out better. So I think most punters out there will be happy with the change. So as you can see here, this talks about the net benefit. So this is for turnovers over the 20 million, the net benefit. You can see that it's 16.5. When you look at your rate, depending where your corporate rate is 30% or down to that 25%, because we're talking about the year 30th of June 2022, you're going to be much better off. You've got 46.5% if you're in the 30% rate, whereas currently it's 38.5. So you are getting much more there. And what happens to it is it's actually carried forward. So it is a rebate that gets carried forward. It gets offset against any of your taxes in the future. So just jumping onto JobKeeper, I know that wasn't in the budget, but I think it's just appropriate to bring it up here. I'm not going to spend too much time on it, but just to remind everyone, Some of you may be on it already for the 27th September to 3rd of January. I'm not going to discuss that. You're in, you've already know that. But what you need to remember is that if you weren't in, you previously were in it back in 30th of March to 27th September. You didn't qualify for some reason between September and January, potentially can still qualify for that period of 3rd of January to 28th of March. You do have to test. So what's the difference in the different periods? Well, obviously the JobKeeper has been reducing. So if you look at it for what's left, for 4th of January to 28th of March, if you're in that higher tier, being 80 hours or more that an employee works, you get that $1,000. And if you're lower than that, you give your employees $650. So that's the minimum you have to pay them. Everything works the same as the JobKeeper previously did work. It's just a tiered approach and different, and you just have to reassess. Just a different way to show it. People like it in different ways. You know, when do you have your BASs to lodge? So if you think about it, you know, 4th of January to 28th of March, you'd be lodging your BAS in February. You know, that's all relevant. But again, when you're enrolling, you'll be enrolling in early January. So you have to keep in mind, you know, what have you effectively lodged in your BASs for October, November, December. So that's the test period for that January to March months. So we've talked about this, is if you're over 80 hours, under 80 hours, what are you going to get from 4th of January to 28th of March? I'm not going into too much detail. I think most of you are aware of it. If you're not, happy to chat anytime. That just shows it as one, you know, JobKeeper fortnights. So when is the fortnight? People always want to know what that looks like. So this gives you a bit of an indication. You can see that December, the last payment for the JobKeeper for that period, 27 September to 3rd of January, is going to fall into that February period, if you like, for payment. So you'll have 3 payments in that period. One from the old JobKeeper, and if you're if you're in that period from January to March, you'll also get those 2 amounts for January. There's no real change to the other rules. This is for you to read in your own time. You know, what is an eligible employee? What is eligible business participant? All those things haven't changed. Your specified percentage is still the same. So, you know, if you're a registered charity, you can still exclude grants if you previously excluded them. There's an enrolment process, there's an assessment process, and it's monthly reporting of turnover. Just remember your basic test, it's your actual GST turnover. You know, has it decreased by 15, 30 or 50? Most of you will be in the 30%. Compare your December quarter to your December quarter, so December 2020, so to December 2019. Most relevant alternative tests. So most relevant is where we've been using is substantial increase in your turnover, or you have irregular turnover. So if you don't meet the basic test for that period, October, November, December, and for some reason you can't compare, it wasn't there, or your business has changed substantially, it's increased in income, then there are some ways that you can look at it differently, and we've been assisting clients with that. So just a summary. So need to reassess again. You'll be reassessing in January. You'll be looking at your December quarter 2019, comparing it to December quarter 2020. Has you increased or not? You get a basic test. You didn't meet that. Go to the alternative test. Do you meet one of the alternative tests? If you do, then you might be in. You don't need nominations if you already had nominations, but the JobKeeper payment reduces. So you need to ensure that if you've got someone stood down and you're paying the minimum amount, you have to pay them $1,000 and not $1,200 or whatever the amount might have been, and $650 if they were working less than 80 hours. 80 hours for the last fortnight. And then the business participation entitlement, it's still valid. So if you are, you know, not an employee, but an owner of the business, you can still potentially get the JobKeeper. I just went through the JobKeeper fairly quickly because I think a lot of you already know about it. It was just a reminder more than anything. And I wanted to make sure we have time for the JobMaker credit. What was interesting about this is it applies to new jobs created from 7th of October. So today we've got on the 11th of 11th. So we're in already. We're in the game to the 6th of October. Now it's attracting JobMaker hiring credits. So for up to 12 months. So you get some money back from the government, put into your bank account in arrears, and I'll go through that, up to $100 a week to $200 a week for any additional employees that you hire. There is always some criteria around it. I'll go through that in a minute. So that you look at the 30th of September 2020 and you get your head count, so full-time, part-time, casual, and you compare it to the quarter. So anything from 7th of October for 3 quarters. So that'll be about the 6th of January, October, November, December, January. Yep, 6th of January, 3 months. And has there been an increase in headcount from that base period? So new employees, you don't have to worry about turnover. It's all about new employees. This is about getting people into jobs. The only thing to watch out for is you can't be on JobKeeper to get it. You could get it down the track when JobKeeper finishes, but you can't, you're not eligible if you're on JobKeeper. So the criteria to be eligible employee, so employee must have been, so must have been on JobSeeker, must have been on some youth allowance or parenting payments for at least 1 month of the previous 3 months at the time of hiring to be claiming the quarter in arrears. So effectively, if you look at, take 30th of September, you've hired someone in October, you look at the last 3 months, were they on any of these allowances? Effectively, you've employed someone. If they were, then they potentially would be in. Now, the next criteria, obviously the commencement date. Now, employees are eligible if their ages 16 to 29. Now, this is not discrimination. I don't know what is of age, but you get $200 a week for each week up to every week up to the time, every 3 months, basically. So it's quite a bit of money. You multiply by your new employees. It's not a bad concession. And if your employees are between 30 and 35, then it's $100 per week. Worked at least 20 hours on average per week. So 20 hours they have to be working each week up to the time of, the 3 months ending. So it's circling every 3 months. That's when you're testing. It's a bit like that JobKeeper, you test it every month. Well, this you're testing every sort of 3 months. And then, yeah, it's applicable to most of your staff. Not to your contractors, though. So you have to be clear whether you have part-time, full-time, or casual when you're employing people after 30th of September. Additional criteria, well, obviously there's got to be an increase in headcount, and that should be 30th of September. You increase in payroll tax for the reporting period. So the reporting period is you're testing that 3 months up to 30th of September. You look and see what that looks like and compare it to the 3 months in the new period. So October, November, December, you look at that period and say, okay, has there been an increase in my payroll? Now you think if there's a headcount increase, you've increased your payroll, just a criteria. Who's an eligible employer, you may ask? Well, you can be anyone, so long as you're an employer. You need to have an ABN, need to be up to date with your lodgements, income tax, BAS lodgements. You need to have obviously employees. You need to be reporting on STP. You need to meet the additionality criteria, which is the additional employees and additional payroll, as we talked about before. You need to be claiming in respect of eligible employees, so the age group. Have kept adequate records and paid hours worked. So you've got to make sure you've got that 20 hours average per week. Excludes government departments, as did JobKeeper, but it actually excludes people on JobKeeper because you're trying to create jobs here. Your new established businesses, if you establish a business in October, November, or some other time, you can still be eligible. Just your first employee won't be eligible, but anyone after that. So check if you're an eligible employer. Go back to the criteria, check if you're in there. Track how many employees, full-time, part-time, casual, you had at 30th of September. Question, are you on JobKeeper? If you are, forget it, but look at this later. Track new employees between those ages. Don't need to register at the time of hire. The registrations portal is open in 7th of December, but the trick is that you're not really going to be able to report anything until probably submit any claims until February. So they pay you 3 months in arrears. So as we said, the dates are 7th of October to the 6th of January. They might open before then, but effectively you can put all your information in, but you're not going to get your submit your claims until early February, and you get your money in February. So you get your money for the 3 months. So if you think about it, October, November, December, you've got this new person that's under the age of that 25 or something, whatever it is, 29, then you're going to get that $200 a week for that person up to that time, which is the 6th of January. And then the next 3 months you get it as well. So this keeps going for 12 months. So as I said, receive $100 or receive $200 depending on age, paid in arrears. A bit like the JobKeeper, the way it runs, the administration of it, except it's 3 months instead of 1 month. At time of hire, employees fill out nomination forms. So there will be a nomination form. I don't think it's out yet. Employees need to keep. That's basically saying that they're not getting it somewhere else, that they're between those ages. So let's look at an example now. So this is our last slide. It just gives you a nice example. It's easier to explain it by an example. So baseline 30th of September, you had 2 employees and your payroll was from July to September was 30,000. Now, in the first review quarter, which is that October to June, you've got 4 employees now and your payroll is going up to 60,000. Now, your 2 new staff started in October, anytime in October, and then they're aged 28. So that person will get 200, and the other one was aged 31. That person will get 100. They both worked greater than 20 hours. They're working 20 hours, more than 20 hours a week. Fantastic. So that means you just need to give them a nomination form. You can enroll in February if you meet all the criteria, and you get paid in February. Really simple, right? There's a few hurdles, but once you've got those down packed, there's a lovely fact sheet, which I think we can circulate. Tanya can circulate that with the slides after they've just been updated and cleansed. I think that's a great benefit if you're not on JobKeeper. When JobKeeper ends in March, I think you can still go on to this as well, because this runs for 12 months, as I mentioned before. So if someone comes on at the last date of this concession, they effectively will get the concession for 12 months. So what did we say? It was 2021 March, the date that this ends. October, I think, October or something like that, 2021. You effectively, if the person joined a couple of days before that day, October 2021, they still get that for 12 months, so long as all the criteria is met. So you as an employer get that money every quarter for 12 months from date of employment.
Well, that concludes our webinar this morning. I'd like to thank you all for joining us, and we hope to see you next time.